Hello out there. Welcome to another edition of Macro Mondays, live to you on YouTube, Twitter, Real Vision, wherever you want to watch this, or if you're just listening in on the podcast afterwards. My name is Mikkel Rosenvold. I'm your usual host. And with me today, of course, as usual, Andreas Dino. Welcome to you, Andreas.
A shaved version of Andreas
Shaved,
Dino.
much younger.
Not much younger. I look much younger, thankfully. But, when I shaved this weekend, I went to the bathroom and then I got out again. And my baby boy, he was like, "Who the fuck are you?" It took like 2 or 3 hours before he wanted to sit with me again. So yes, it's a new look, to say the least.
As long as your iPhone recognizes you and you can open that. I mean, that's a great start. Andreas, it's really busy times at the office.
Yes.
We're not here to advertise that, but we are opening our very own strategy today, beginning trading today. How's the first day been?
Messy. I don't want to add some.
Absolutely.
Yeah.
As I said, this is not a strategy. It's not an attempt to advertise it, but a disclaimer that we're doing our very own strategy now. We will be bringing in our knowledge and our findings from that, obviously, and to me at least, it's the ultimate version of putting your money where your mouth is. You're putting your own money, my money, our investors' money where your mouth is. So that's where we're at now.
That's the scary part of this, that I'm actually investing your money now, Mikkel, because I guess the mood in the studio can turn really bad in a few weeks from now. But
absolutely, it's everything I have almost. Haven't sold the house yet, but
well, you need to in a couple of weeks.
Yeah, I'll probably have to. So, Andreas, in this strategy, we're not trading crypto at all. That would have been a real shame if we started a month ago. But anyway, I just want to talk a little bit crypto to begin with. And it's not what you think, because, I mean, Andreas, when we did the Pro Macro show with Ro last week, I kept asking you guys, are we entering monkey JPEG territory? And now I just found, I'm learning today, I just found that the floor price on the Bored Ape Yacht Club NFT collection is going through the roof right now. It's not 2022 levels at all. We were there actually in early 2024, so it's nothing. But is there anything to this? Are people struggling on where to place their money, trying to find new 200% a week bets?
You can take this as a hint that what I typically label esoteric risk taking is potentially going through the roof now. I think we've seen the first signs of the attention span moving from Bitcoin to altcoins, and I guess this is a part of that journey. We've had plenty of questions over the past few weeks on whether this is the time to move from Bitcoin to Ethereum, for example, in your allocation. I think it is. Let me just disclaim that. And, when we look at the developments, especially late last week, I think it was very interesting to see that flows started moving towards altcoins quite substantially, also in the ETFs, which is actually the first time we've ever seen it. I think we have a chart on it with the flows into the ETFs.
Yeah, exactly.
And this is the flow into the aggregate flow into Bitcoin ETFs versus Ethereum ETFs. And as you can see, the light blue bar here is from Friday, and we actually had a larger inflow to the Ethereum ETFs relative to the Bitcoin ETFs for the first time ever. I guess that's something to take notice of. And, it rhymes with what we've discussed on this show and elsewhere. Maybe we're getting to that part of the cycle where we get risk-taking further out the risk curve, even in crypto space. And this is a good sign of it from a flow perspective as well. So I think it's something to bear in mind. And we typically see this when we get the first signs of an improving business cycle. And just as we went on air, the ISM Institute released its monthly report. Haven't seen the numbers in all honesty, but my best guess is that we're starting to see some signs beneath the hood that the business cycle is improving. Our medium-term outlook on the business cycle is, especially when you look at manufacturing, is really positive. But there's a great divergence to discuss between services and manufacturing, and we'll get back to that today, Mikkel.
Absolutely. This might be a good time to point out that this is based on our analysis, our data models. of which we share a great deal with the Real Vision subscribers. You can get that on the Pro Macro tier. Among other things, you'll get access to our very new article series, What We Told Hedge Funds This Week.
Yes.
Very short and sweet title, but it tells you exactly what's underneath the hood. We collect all the most important points, charts, etc. That we tell hedge funds, the hedge fund clients that we have throughout the week. So go to the Pro Macro tier to check that out. But remember, and we haven't had that for a couple of weeks, Andreas, that whatever we tell you on this show and what we write in our research, it might be
sometimes maybe good, sometimes maybe shit.
I don't know if that worked, Andreas. We're still working on the technicalities. Anyway, it might be sometimes maybe good, sometimes maybe shit.
Yes.
That is our motto on this show. We're still trying to get it out there live because we don't have, sadly, Gennaro Gattuso in the office here. and I just want to, while we're at crypto, obviously we try to be very, very short term, and this is the short term outlook. Very, very interesting. In the broader long term, we had some early ideas of a Trump crypto plan. I saw on X. Some notions that of strategic stockpiling of Bitcoins, the issuing of stable coins pegged to the US dollar. What do you make of this? I mean, we've talked about this before, whether the US government would get into actually buying and holding Bitcoins. Do you think that's realistic?
Indeed. But I'm not sure that they will buy anything but Bitcoin. If you look at Trump's own holdings, I think he's much more into Ethereum, actually. But anyway, that plan was laid forward late last week, and it included some interesting points, including sacking Gary Gensler. But it's crystal clear that they have a plan to include crypto as an important topic, also from a legislative perspective. And for good and for bad, I think we can have lengthy discussions also with the audience of this podcast on whether it's a long-term good thing that DC becomes a lot more involved in this topic. And, I have mixed feelings about it, to be honest. But sure, if they build up a reserve of Bitcoins, should be bad news from a flow perspective, right? Yeah.
That's it. Very, very interesting, Andreas. We have a great show for you out there today. We're going to talk a little bit about bonds, a little bit about China, a little bit about services and other good stuff. Where do you want to start, Andreas?
Can we talk about Hunter Biden first?
We can, absolutely. Getting a pardon from his old man?
Yeah. So, it actually caught me by surprise, to be honest. And, I actually expected Trump to do it.
Expected Trump to do it?
Yes, because, it would have been a very, very easy way for him to put all of those discussions around a hostile environment between the Democrats and the Republicans to bed. And my best guess is that Joe Biden would not allow Trump to do it. That was why he took the decision.
Could be.
So Trump told him, I'm going to do this.
Okay.
That's my best guess. Because otherwise, why now? I mean...
Yeah, because it's his last chance to save his son. I mean, son is probably going to get persecuted anyway. It's what you do when you're leaving office. You can get to do all these kind of things. One guy that's not leaving office anytime soon, Andreas, is Xi Jinping. Should we start talking a little bit about China, because you had a very, very interesting chart. We've touched upon this briefly before. I'll just want to show you this chart. It seems like China is selling off gold or putting gold in the market. What are we looking at here?
Yes, you can, if you want to read this chart in that way. But this is the amount of gold on warrant at the Shanghai Futures Exchange. So, that amount is through the roof. And it's been like that through 2024. That obviously happened in conjunction with the gold trading activity picking up, largely speaking, across the board in China, but also across the board in BRICS countries. And, we're 2-3 years into that new environment geopolitically, where if you're a member of the so-called global South, you don't have any whatsoever guarantee that the US authorities will not seize your reserves, right?
No.
It happened to Russia. It happened to a lot of wealthy people in Russia. And as a consequence, right after that decision was taken, obviously, if you're a part of the leadership in China, you had a meeting. Okay, how do we deal with this sanction risk or this risk of getting our reserves seized, right? And one of the very easy ways of dealing with that is to buy physical gold, obviously, because you need boots on the ground to seize that. It's as short and sweet as that. So I think we need to see the message from Donald Trump over this weekend in light of this. He basically threatened with a 100% tariff on BRICS countries if they moved away from the dollar in their reserves, basically. And one way of moving away from the dollar, at least de facto, is to use your dollars to buy physical gold, right? Because you cannot seize that. You can seize a reserve portfolio of US treasuries, for example. And a couple of weeks ago, maybe 10 days ago, China issued its first sovereign bond in Saudi Arabia. And while it's largely symbolic, there is maybe an added layer to this from a geopolitical perspective.
And you just have to explain this to me, Andreas. It was a dollar-based bond out of Jeddah. What does that even mean?
It doesn't mean a whole lot, to be honest. But you can offer an offshore dollar bond in Saudi Arabia, so it's not traded onshore in China. But you could have chosen another offshore venue. It doesn't really matter whether it's Jeddah or not. I think it's largely symbolic that they want to increase financial ties with Saudi Arabia. This is a way of ensuring that a few fees will reach Saudi Arabian banks, etc. Right?
But why dollar? Do they need dollars? Is that why? I mean,
it's early days. But this dollar bond was vastly oversubscribed. And my best guess is that China's trying, at least testing the waters, on whether they can create some sort of light US Treasury proxy prone to fewer sanction risks.
See.
So if you're a central bank in the global south, in Brazil or, Egypt or whatever, you can buy this Chinese dollar bond with fewer sanction risks attached to it. And, ultimately, I guess it depends on whether China, from a credit perspective and from a credibility perspective, is at as good a buy as the US. But they've increased their ties substantially with this pool of global South countries over the past decade. And by issuing Chinese dollar bonds, they actually offer these countries an out if they would like to keep the dollar in their reserve, but dislike keeping them in US treasuries or in gold, for example. So I'm not fully sure how to read this yet, to be honest, but I find it very intriguing that at the same time as we saw this bond issuance in Saudi Arabia, we also started to see the gold momentum getting a little bit exhausted. And if this is a signal to BRICS countries to, alter their strategy a little bit around gold relative to buying other dollar-denominated assets, it could be a massive trigger event for the gold trade.
But I thought when I read all the conspiracy theories in there, everyone talks about China trying to make world trade happen in yuan, not in dollars.
It's not going to happen.
No, that's essentially why I don't understand the Trump threat. But
I think this is, they're trying to figure out whether they can impact the dollar system from within here. And they can obviously do so if they can turn themselves into some sort of lender of last resort of dollars for global South countries. Otherwise, they have to call up the World Bank or IMF or some of these institutions, bringing a load of economists on a plane to tell you what to do after you've gotten the money, right? And China's a different beast in that regards, right? They don't tell you what to do, necessarily, or at least as long as you pay them back and you provide them something in return, they can look through human rights and shit like that, right? Sorry, but
I mean, it could be seen as a nice addition to the Chinese subscription package, as I like to call it. As a third world country, you can decide, or as global South country, decide the US package. It gives you a lot of high-end weaponry, a lot of them, a lot of genes, a lot of democracy. You can call China. They have the cheap surveillance equipment that the US can't make. A lot of cheap energy now with Russia as well. They don't ask as many questions, and now if they can deliver both yuan and dollar-based lending, I mean, yeah, interesting to see this. I don't understand this Trump threat, though. I mean, is it really realistic that they're going to drop the dollar? How would that even look?
Yeah, it's not a short-term risk, and even with, say, 2-3 years of complete geopolitical turbulence, we're still trading in dollars, right? It's not like it's something that will end tomorrow, and ultimately, you need especially commodities to trade on another venue, basically, to get global trade redirected towards Chinese yuans. You need a much more open capital market for that to ever be a considerable risk to the US. So look at it this way, Mikkel. If you're the largest holder of reserves, is probably the Chinese central bank itself, but other large official institutions around the world. And if you put Chinese yuans in your reserve basket in a central bank, you want a liquid and open market beneath that yuan market to really get involved, right? Because the last thing you want is to not be able to utilize those reserves in case needed. And if the market is illiquid and prone to capital restrictions and all that, it's not really going to be a good addition to your reserves portfolio. But still, something happened the exact day where Russian reserves were seized, because it was it was obviously a tail risk for these global South countries that they could get their reserves seized by the US authorities, but it probably wasn't considered that true a risk or clear a risk, right? And now it is a risk. So, we're at crossroads here, and it seems like Trump is trying to sort of kick the can down the road on this question by threatening the BRICS countries. They don't have a credible or feasible alternative to the dollar as of now, but they were obviously stuck in discussions on creating a BRICS currency. It's not that we're anywhere near it. I mean, these guys are not even trading with each other in some sort of BRICS setup, right? We're very far from it, but it's going to be a question for our lifetime. That's still my opinion. Yeah.
Very interesting. Just quickly, Andreas, before we move on, I just want to touch upon the ruble. We heard a lot of talk late last week about the ruble collapsing. How big a deal is that to Russia? Because the way I see it, Russia, they're not importing a lot of consumer goods. As long as they're buying internally from own production, what does it even mean? Is it such a big deal?
Well, you can actually argue that, everything that they settle in foreign currency, such as some of their energy products, etc., exactly. it will actually make them, quote unquote, richer. But of course, they are reliant on imports to some extent from China and other allies. But no, they're self-sufficient in everything you need, which is not the worst package if you're running a war.
No.
They've got vodka, caviar, and energy. What more does a man need?
Yeah, and they can settle a lot of their trade for weaponry out of North Korea with grain, etc. They essentially bartering grain for soldiers. That doesn't have to involve any currency. Okay, enough about currencies, Andreas. Do you want to talk equity positioning, bonds? What do you want to touch on?
One, we intend on being actionable in this show, and famous last words, because I've been down this rabbit hole before this year, but
the gold trade.
Yeah. I think there's some value in trying to play the catch up in the manufacturing cycle in, for example, copper or silver versus gold here, which is a trade that has been bombed out this year. But if the manufacturing cycle picks up, there is a really good case in, for example, copper versus gold here. And yeah, let's see whether it will be my final attempt on this.
Very interesting, Andreas. I just want to touch upon, you wrote in your Steno Signals article this week about how everyone expected the Trump administration to spill over into bond yields, but we haven't really seen that. Maybe let's pull up this chart of the growing divergence between bond yields and oil. What are you seeing in bond space right now, in fixed income space?
Outside of today, it's been one-way traffic down basically for a week in a row, which is exactly what we traded and what we basically forecasted for month end November and December. And why is that? We had the debt ceiling upcoming in the US, meaning that the supply will be a little lower. We have a big divergence, as you say, between energy commodities and bond prices, which is not something you typically see for a long while. I think there was this notion out there that Trump would drill, baby drill, but also be very inflationary at the same time. And one thing I've learned, and I've learned that almost for good, being part of that energy market in Europe since 2021, energy is life. You can sit here in Europe talking about putting up wind turbines and not having any local energy sources and all that, but it just doesn't work. It just doesn't work. And my point here is, by bringing that up, is that notion that you can get oil prices substantially down, nat gas prices substantially down, at the same time as bringing bond yields substantially up in some sort of inflationary mix, but with energy prices down, it just doesn't add up over time. Energy is life. Energy is activity, including AI. If the price of electricity is AI. So if the price of nat gas drops, the nat gas turbine that you'll set up right next to your data center becomes cheaper. AI becomes cheaper.
And energy is disinflation, or lack of energy is inflation. We've also learned that.
Yeah, sure. So drill, baby, drill, inflation expectations down ultimately. That's what I'm trying to say here. And they've been, it's probably one of the few areas where all of the loyal soldiers of the Trump administration agree. They want to drill. And I think we should take that seriously.
Absolutely. Andreas, before we round off, let's just touch upon the macro outlook for the US. I like to pull this one up. This is our macro regime model for the US economy. We're seeing everything drop, both the likelihood of high growth, liquidity, and inflation. How do you view the US macro regime right now?
So, down, right? Yeah. Inflation clearly accelerated after that 50 basis point cut back in September. It seems like we've peaked now. I think that's a crystal clear message from our model package. At the same time, as we're starting to see some weakness, especially in services, everything domestically based, more or less, right, in the US. And it looks somewhat reminiscent of what happened back in April, May. And remember what ultimately happened over the course of the summer. We had a couple of nasty non-farm payroll reports. I think it's a big one, the one on Friday, the non-farm payrolls report, because everyone I talk to, they tell me, okay, Andreas, you should look past what happened last month. It was the Boeing strike. It was the weather, hurricanes, etc., leading to a bad non-farm payrolls report. But what if we don't rebound this Friday?
Yeah.
Then that notion, it's blown into smithereens, basically, in a split second. And that would be big thing for the bond market. And as I've said, I actually consider it a pretty good thing that we get some bad data from the US, because central banks have been they've been a little hesitant adding liquidity here. And that's basically what we need to get the next leg higher in a lot of these liquidity sensitive trades in crypto, risk assets, and all that. So ultimately, if you want markets to rally, You need to cheer on a few bad labor market reports again, because otherwise they will turn too tight again.
Because it seems to me here that if I was sitting at the Fed looking at this, it seemed to me I just touched upon the speeder and boom, I got a big spike in inflation.
That was kind of the impression they got, right? So they need some sort of political excuse to continue easing now, and maybe they'll get just exactly that from a service sector weakening a little bit here.
Very interesting, Andreas. Let's talk portfolio setup. What are the bottom line of all this, the grand trade ideas of this week?
So I think the bond outlook is very asymmetrical during September. Basically, fixed income will perform well. Bond yields will drop in such a scenario. Should be good news for everything sensitive to bond yields, right? We're talking NASDAQ. I also saw on the screens before going in here that NASDAQ was doing well today. We're talking esoteric risk taking in crypto. We're talking monkey JPEGs. But I think there's one thing to notice here, and it's been a very, very consensual trade, that the big banks in the US, they've been thriving right, left, and center since the election results. And Dow Jones, for example, has been a clear consensus bet. I would much rather put my money in the small cap Russell 2000 space if we get bond yields substantially lower. And I think it's a really good relative value trade versus the larger caps outside of technology. Let me put it like that. So NASDAQ, Russell, bond yields lower. Weaker dollar, by the way, especially versus some of the Asian currencies, such as the Japanese yen. And no, I'm not talking about a repeat of what happened with the yen over the summer, but something in the same direction. And, let's see in Europe, because I think the worst performing market over the past month is France. And just before we went in here, it seems like the rug was pulled from under the French administration. I had the chance to meet Jordan Barea. I think I've pronounced it correctly. So the leader of Front National, the right-wing party in the French Parliament, when he visited Denmark, and they kind of travel with the message that the election was kind of stolen from them because of the electoral system in France. So they really want to get a new election, and they want Macron to step down.
Yeah, they want a presidential election this time around.
Yes, because they have the sense that they can win it this time.
Exactly. I mean, you are seeing incumbents being thrown out right, left, and center. Maybe another one in the UK before New Year. Who knows? And the French presidential election isn't due until 2027. I think it's going to take a lot more to pull out Macron from the Élysée Palace. But let's see. And just while we're on that topic, we've actually managed to cover most of the audience questions without me directly mentioning them. One that we've also got, just finally, at least here in Denmark, is becoming a red-hot topic that the upcoming EU budgetary discussions will include the EU taking its own debt, essentially.
Yeah. They've already started that during the pandemic, but...
they already dipped its toes in it. A lot of people were worried that this would set a precedent, that you could always return to that as a policy instrument.
Well,
that's probably what we're seeing right now. Do you think it's realistic? Is it a good idea?
So, it reminds me a little bit, not that I was born at the time, but of the discussion in the US back when the federal debt wasn't that large. And of course, there are some like cross-border issues that you can deal with if you issue common debt. But the issue is whether you have the backing of the member states. And I don't think that the backing is there for the time being. So I think the best words on this were said by the former head of the commission, Romano Prodi from Italy. He said that, okay, we know that we constructed the European Union and the euro with a lot of flaws. but we need a crisis for us to be able to implement the setup that we actually wanted to implement. The pandemic was a good opportunity. They got those instruments in place, and now we've basically opened the can of worms. And if you're watching this from the US or listening to this from the US, the European Union is basically the federal setup in the US on steroids, basically, because, we don't even have a common language, right?
No.
And do I want to issue debt to build bridges in Hungary? Yeah, I don't know, really. We don't have that lot in common, right? So it's
where does this end?
Yes.
That's my big worry in all of this. Where does this end once we start taking on debt? I mean, it's, on the other hand, I'm also thinking everyone is telling the EU to wake up, but no one wants to give them any money.
Yeah,
I mean,
but,
that's...
the euro is basically trading through the floor versus the dollar at the moment and versus Japanese yen and all sorts of currencies.
That's what we need.
Yeah, but it's not too bad for the export sector. But I think, and we promise you that we get back to that, if the German election results in some sort of de facto breakup of their debt ceiling, or their Schuldenbremse, as it's called in German, that's a big, big moment for Europe. And one that kind of resembles what happened in China a few months back. I think we'll get a very positive response from markets to such an event. We see how Germany is doing well over the past week, now that the ECB is talking about 50 basis points cuts and all that. So I actually think there are some opportunities in Europe outside of France right now, for those wanting to get involved a little bit outside of the US as well in equity space. I know we've talked about the European case on the short side for a while, but I'm starting to warm up a little bit ahead of that election in Germany. And our models are not that dire anymore. So I think that's worthwhile mentioning. But and we can maybe link that to the question we've received on nat gas, Mikkel, because we've been asked to talk about the nat gas outlook. And if the price of nat gas goes up, Europe is still in trouble. And that's also partially what you've seen in the euro. If you look at the nat gas curve in Europe, which basically spills over to the term structure also in the US nat gas market, we see the summer trading at an extreme premium to the winter, this winter in futures, which is something you typically see when there's an expectation of a large drawdown in the storage over the winter that needs to be rebuilt over the summer where we don't use as much nat gas. And I think that's a pretty feasible thesis for now, meaning that we have this very steep curve. Ultimately, where does this leave us this winter? We need a meteorologist in here to answer that question, because we're basically talking about this due to a very cold, very dark period without any wind, and that's the worst possible cocktail for Europe, since we only have solar and wind here. The rest we're buying from the outside, right? So if it's dark and there's no wind, we need to fix the situation with stuff from the outside.
It's dark times in Europe anyway. Let's hope the Germans can save us once more. Anyway, Andreas, that's all we had for this week. Thank you to all of you for joining in. We appreciate all your questions, all your support. Remember that you have a what's it called, State of the Union show for the
Pro Tier.
For the Pro Tier in Real Vision. We do the weekly Pro Macro as well, and we release a bunch of articles on what we tell hedge funds. So go check out the Pro Macro Tier. It's really worth it. Thanks to you, Andreas. Thanks to all of you out there for joining. We'll be back next week.
Sometimes maybe good, sometimes maybe shit.